For decades, the idea of replacing the US dollar has resurfaced again and again. Different countries, different crises, different moments of tension. But the outcome has always been the same. The dollar remains at the center of the global system. Not because it is perfect, not because it is fair, but because replacing a reserve currency requires more than ambition. It requires structure. Many people assume that reserve currency status is a political decision, that governments simply choose what to hold. That power alone determines the outcome. That assumption is wrong. Reserve currencies emerge from systems, not speeches. A global reserve currency must do several things at once. It must be widely accepted for trade, deeply liquid in financial markets, freely convertible at scale, backed by legal certainty, and trusted across borders, including by rivals. These requirements don't appear overnight. They take decades to build. History makes this clear. The British pound did not lose reserve status because the United States demanded it. It lost it because Britain could no longer sustain the financial, military, and economic burden required to support a global currency. The dollar replaced the pound only after the US had the deepest capital markets, the strongest industrial base, political stability, and the ability to project trust globally. This wasn't ideology. It was infrastructure. Today, many discussions focus on China, its economic size, its role in global trade, its growing influence. All of that is real. But size alone does not create a reserve currency. China's currency, the renminbi, plays an expanding role in trade settlement. That matters. But trade settlement is only one layer of reserve status. The deeper layer is capital. And capital behaves differently. Global investors don't just want access. They want exit. They want to move money freely, in large volumes, without fear of restriction. They want transparent legal frameworks, independent courts, predictable enforcement. These are not political judgments. They are operational requirements. This is where the challenge appears. China maintains capital controls. Its financial system prioritizes stability over openness. Its currency is managed within defined parameters. These choices are rational from a domestic perspective, but they impose limits on global adoption. A currency cannot be both tightly controlled and universally trusted at scale. That's not ideology. That's mechanics. Another critical factor is debt markets. Reserve currencies require massive, liquid bond markets where institutions can park capital safely. The US Treasury market serves this function, imperfectly, but uniquely. It is not just large. It is continuous. It absorbs shocks. It provides collateral. It anchors the global financial plumbing. No alternative currently matches that depth and flexibility. This doesn't mean the dollar is unchallenged. It means the challenge is structural, not rhetorical. And structures change slowly, which is why efforts to diversify away from the dollar tend to produce fragmentation, not replacement. More bilateral trade in local currencies. More regional settlement agreements. More experimentation. All of this reduces dependence. None of it creates a single alternative. That distinction matters. Reducing exposure is not the same as replacing the system. As the global system evolves, what we are seeing is not a clean transition from one reserve currency to another. We are seeing fragmentation. Multiple currencies. Multiple settlement channels. Multiple layers of trust. This is more complex and more fragile. Fragmented systems require more coordination, not less. They increase transaction costs. They reduce efficiency. They amplify stress during volatility. This is why, during crises, capital often flows back to the dollar, even when confidence in policy is strained. Not because the dollar is loved, but because it is usable. Gold plays a role here as well. Not as a replacement currency, but as a neutral asset. Gold does not depend on policy credibility. It does not require convertibility. It does not need a legal framework. It exists outside the system, which is precisely why it re-enters the conversation when trust becomes conditional. Central banks understand this. That is why gold accumulation has increased globally, including among countries seeking to reduce dollar exposure. This is not an attack on the dollar. It is a hedge against system complexity. None of this suggests an imminent collapse. There is no countdown clock, but there is a direction of travel. Less universality, more management, more emphasis on resilience rather than efficiency. In that environment, the dollar doesn't need to disappear to matter less. It only needs to share space. And sharing space changes how the system behaves. This is the key misunderstanding in most discussions. The future is not binary. It is not dollar dominance versus dollar collapse. It is a system adapting under pressure. China's ambitions reflect that pressure. So do Europe's efforts. So do regional currency experiments. So does gold. They are not signs of revolution. They are signs of strain. And strain does not produce immediate replacement. It produces gradual adjustment. Sometimes quiet. Sometimes technical. Often misunderstood. That is why, despite all the discussion, the dollar still has no real replacement. Not because alternatives don't exist, but because no alternative yet meets all the requirements at once. Understanding that difference matters. Because the system is changing, just not in the way most headlines suggest. If you want to understand how global money is actually evolving, the signals aren't found in declarations. They're found in structure, in liquidity, in trust, in what still works, even under pressure. Everyone's asking the same question: what will replace the US dollar? We see headlines about de-dollarization, new currency blocks, and the inevitable decline of America's financial dominance. It's a compelling story, but it's the wrong one. The real question isn't about what comes next. It's about what's happening right now. And what's happening isn't a replacement. It's something far more subtle, and in many ways, more profound. It's fragmentation. Imagine the global financial system not as a kingdom with one ruler, but as a sprawling, interconnected network. For decades, the US dollar has been the superhighway at the center of this network. It's the most efficient, most liquid, and most direct route for almost everything: trade, debt, investment, you name it. This efficiency is what made it king. But the network is changing. New roads are being built. These aren't superhighways designed to replace the dollar. They are smaller, regional routes, local shortcuts. Think about it. The future of global money isn't a binary choice, like flipping a switch from dollar to yuan. It's a shift from a simple, centralized system to a complex, multi-layered one. In this new world, trade might be settled in one currency, debt issued in another, and a country's reserves might be a cocktail of several different assets. This might sound like a good thing, diversification, right? But it comes at a cost. That cost is friction. Efficiency is what made the dollar dominant. One single, incredibly deep market. One universal settlement layer. One primary source of liquidity for the entire world. Fragmentation gets rid of that elegant simplicity and replaces it with redundancy. Now, redundancy isn't all bad. It creates resilience. If one part of the system is stressed, you have alternatives. But it also creates friction. Suddenly, you have higher transaction costs. Businesses need to do more hedging to protect against currency fluctuations. You need more middlemen, more brokers, more complex financial instruments just to get things done. The system still works. It just has to work a lot harder. This is the key point that so many discussions about reserve currencies miss. We are not looking for the dollar's replacement. We should be asking, how much complexity can the global system actually handle before it starts to break down? Complex systems don't just fail overnight. They adapt. They add safeguards. They build new layers of control. They start relying more on careful management than on the free-flowing, spontaneous nature of open markets. And this management leaves footprints. One of the most obvious footprints is increased intervention. We are not just talking about central banks intervening in currency markets. We are talking about intervention in interest rates, providing emergency liquidity facilities, and creating market backstops to prevent crashes. These aren't signs of weakness, as some might claim. They are signs of strain. The system is being pushed to its limits, and policymakers are stepping in to hold it together. Another footprint is the changing behavior of capital itself. In a highly efficient system, money chases the highest return. It's opportunistic. But in a complex, strained system, capital starts to prioritize something else: reliability, safety. Liquidity becomes more selective. Investors prefer short-term debt over long-term commitments. Diversification stops being about finding new growth opportunities and becomes a defensive strategy to protect what you have. This shift doesn't require a full-blown panic. It just requires a little bit of uncertainty. And this is where an ancient asset quietly re-enters the conversation: gold. Not as a direct challenger to the dollar. Not as some political statement, but simply as a neutral reference point in an increasingly complicated world. Gold doesn't solve the problem of fragmentation, but it exists outside of it. It doesn't depend on any country's payment network. It doesn't need convertibility guarantees from a central bank. It doesn't rely on cross-border legal agreements. The role of gold is expanding not because trust in the system is collapsing, but because trust is becoming conditional. This explains a pattern that confuses a lot of people. Central banks are buying gold in record amounts while still operating within the dollar system. That's not a contradiction. That is smart risk management. Buying gold isn't a vote against the dollar. It's buying insurance against complexity. It's a hedge against the friction and uncertainty of a fragmented world. The same logic applies to all the other alternatives you hear about. Regional currency arrangements, bilateral trade deals that bypass the dollar, new payment systems. None of these are designed to overthrow the entire system. They are designed to route around specific parts of it. Routing around the main highway can reduce your exposure to traffic jams or tolls, but it doesn't create a new, universal highway system. And universality is what a true reserve currency needs. This is why, paradoxically, as the system fragments, coordination becomes more important than ever. The more complex the plumbing gets, the more the plumbers need to talk to each other to make sure the water keeps flowing. This isn't about ideology, it's about logistics. It is about central bankers from different countries having to align their policies to prevent the entire thing from seizing up. It also explains why, in moments of real crisis, all that capital that was exploring the side roads comes rushing back to the main superhighway. Not because the dollar system is perfect. Far from it. But because it's the only one that can handle that much traffic at scale. When the house is on fire, you don't care if the fire escape is pretty. You just care that it works. In a crisis, functionality always beats preference. So, if you reframe the debate this way, you see a completely different picture. The future isn't about the dollar being dethroned. It's about managing a global financial system that is becoming less simple, less efficient, and more delicately balanced than ever before. That balance can hold for a very long time, but it requires constant effort. And that effort is starting to become visible. The signals are subtle, but they are there. More government intervention. More coordination between central banks. A greater emphasis on stability over pure efficiency. Less tolerance for market volatility. A smaller margin for error. These aren't just wild predictions. They are the observable characteristics of a system that is adapting to its own immense scale and complexity. This is the real reason the dollar still has no true replacement. It's not because the alternatives lack ambition. It's because the system itself has grown too vast and interconnected to be cleanly replaced. What replaces simplicity isn't a new form of dominance. It's management. It's complexity. And that fundamentally changes how markets behave, often in quiet ways you don't notice until you look closely. So, if you want to understand where global finance is headed, stop looking for a revolution. You won't find one. Instead, look for the small adjustments. Look for the new layers of redundancy. Look for the hedging. Look for the signals of strain that appear long before a crisis becomes obvious. Because the most important changes in our financial world rarely announce themselves with a bang. They emerge, quietly, one adjustment at a time. Thanks for watching, and if you found this perspective helpful, consider subscribing for more.